I want to ask you, Congressman, about the historic debate at the Supreme Court this week on Obamacare. What are you expecting there?
You know, I guess that's up for grabs. I suspect they're going to rule it constitutional, but that's a pure guess out of the thin air. You know, the whole reason we had this interstate commerce clause was not to regulate the economy, it was to deregulate it. They wanted free trade zones, they wanted to get rid of tariffs in between the states, and they wanted a unified currency. So what they need to be talking about is deregulate insurance so we can sell insurance across state lines. That would be a proper role. But to use the interstate commerce clause to monopolize and institutionalize national health care, that is a disaster. But I'm afraid the sentiment, although this Supreme Court is slightly better than in the past, they haven't done a real good job in defending the free market and the original intent of the interstate commerce clause, which was to deregulate, not use it as an excuse to do anything or force you to buy something. This would be a real tragedy if they rule and support this law.
Congressman, the debate now in the markets, QE3. Charles Plosser of the Philadelphia Fed said right here on InsideTrack just an hour ago, not at the moment, but he's still open to considering it. So for you, the question is, what would QE3, more monetary stimulus, mean?
Well, it just would erode the value of the dollar, and the people would suffer that much more. The middle class suffers. When you inflate a currency and destroy its value, the wealth is transferred from the middle class and the poor to the wealthy. So you just continue that process. That's already, you know, what our problem is. But, you know, they talk about QE 1 and 2 and whether there's going to be 3, but actually the first QE was under Greenspan when everybody recognized, well, one of the big problems we had was that he kept interest rates too low too long. So it's constant. It's the whole process that wealth is supposed to come out of the creation of monetary units out of a computer. That's a fallacy, and it has failed in the past, and you can't solve the problem that it created by creating even more money. So, yes, they're going to hang it out there, and the markets will like it. Oh, if they announce today, they're going to have more quantitative easing. They'll say, oh, this is wonderful. But down the road, it's a disaster.
Well, Congressman Paul, it's not just the markets that might like it. Let's look at some of the economic indicators. You know, the economy is expected to grow in excess of 2% this year, better in 2013, close to 3% in 2014. Core inflation, what most people look at, moderate, under 2%. Unemployment declining. What's wrong with that?
Well, not too much, but it's pretty darn expensive to create trillions of dollars and get that meager growth. But the whole thing is those numbers aren't exactly accurate. If you talk about inflation, the real inflation rate is closer to 9% if you use the old CPI and you talk to the average person or the person receiving Social Security. But even Bernanke, you know, assumes, well, we can destroy the value of the currency at 2%. What right does somebody have to take your money and give you $98 back again? But that's policy. And 2% can be 4 or 8 or 10%, and they can't control it. They have no way they can control prices other than wage and price controls. And that is always a disaster.
But Congressman Paul, there's no evidence of an inflation problem right now as a result of all of this policy.
Well, I tell you what, it depends on how you define inflation. Inflation is the increase of the supply of money and credit, and sometimes it raises prices. And sometimes it might raise prices in one area and not others. So oil prices are going up, medical care costs are going up, education costs are going up, and food prices in many areas are going up. So to say that we don't have an inflation problem, but the inflation, the distortion of the interest rates, the manipulation of the business cycle is the real problem. It's the price fixing and the malinvestment and the increase in the debt and the problems we've had, the severe crisis that we had in 08 and 09. This came from inflation, and right now they're inflating like crazy. They're keeping interest rates at 1% or less. That's inflation, and that distorts the market. So you don't even know what the price of money should be. So you don't have savings. That doesn't determine interest rates. The Fed determines. So you have the consequence of inflation, which is very, very severe, and this is why we're not really getting out of this recession. So if you look at a couple of those statistics, that sounds good, but that's far from a real recovery.
All right, I just want to ask you about gold here, because you've brought the gold standard back into the conversation in the debate. Last week, in fact, Ben Bernanke talked about it in his lesson, 4 slides on it. He says the gold standard doesn't work if you look at history. I want to give you a chance to respond very quickly in 20 seconds.
Okay, he said it didn't work, and it was flawed because they didn't always follow it, but they always had fractional reserve banking, and it caused booms and busts. But the gold standard always brought them back down. I mean, just think of we were still on a pretty good gold standard in 1921, 22, 2021, and that recovery occurred in 1 year. But the distortion was not because of the gold standard; it was because they didn't follow the gold standard. Right. So gold restrains the government, and you don't have debt deficits like we have today if you had a gold standard.
Okay, Ron Paul, we have to leave it there.